Hello back to Finance Shares.
Do not forget to subscribe. Investing for wealth accumulation refers to the practice of putting money into various investment vehicles with the goal of growing wealth over time. The primary objective is to generate returns on invested capital that exceed the rate of inflation, allowing the investment to appreciate and accumulate wealth. Here are some key points to understand about investing for wealth accumulation. Investment vehicles. There are various investment options available to individuals looking to accumulate wealth. These include stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate, commodities, and more. Each investment vehicle carries different levels of risk, potential returns, and time horizons. Diversification. A crucial aspect of investing for wealth accumulation is diversifying your investment portfolio. This involves spreading your investments across different asset classes and sectors to reduce the impact of any single investment's performance on your overall portfolio. Diversification helps manage risk and increase the potential for long-term returns. Risk and return. Investing involves taking on a certain level of risk. Generally, investments with higher potential returns tend to have higher associated risks. It's important to assess your risk tolerance and align it with your investment strategy. Balancing risk and return is a key consideration when choosing investments for wealth accumulation. Time horizon. Wealth accumulation through investing is typically a long-term endeavor. The longer the investment horizon, the more time there is for potential growth and compounding returns. This allows investors to weather short-term market fluctuations and benefit from the power of compounding over time. Regular contributions. Regularly investing a fixed amount of money, such as through a systematic investment plan, SIP, can be an effective strategy for wealth accumulation. Consistent contributions help smooth out market volatility and take advantage of the concept of dollar-cost averaging, where more shares are purchased when prices are low and fewer when prices are high. Investment knowledge and research. To make informed investment decisions, it's important to acquire a basic understanding of investment principles and conduct thorough research. This includes analyzing the performance, risks, and fundamentals of the investment options under consideration. It may also involve staying updated on market trends and economic factors that could impact investments. Monitoring and adjustments. Regularly monitoring your investments is crucial. Market conditions and individual investment performances can change over time. Rebalancing your portfolio periodically, based on your financial goals, risk tolerance, and market conditions, helps ensure your investments remain aligned with your wealth accumulation objectives. Professional guidance. Investing can be complex, and seeking advice from financial professionals, such as financial advisors or wealth managers, can be beneficial. They can provide personalized guidance, help create an investment strategy, and offer insights based on their expertise and market knowledge. Remember, investing in financial markets carries risks, and past performance is not indicative of future results. It's important to do your due diligence, diversify your investments, and make decisions based on your own financial situation, goals, and risk tolerance. Investing for wealth accumulation requires patience, discipline, and a long-term perspective. By choosing suitable investments, staying informed, and adapting your strategy when necessary, you can work towards growing your wealth over time. Example of regular contributions? Regular contributions refer to the practice of consistently investing a fixed amount of money at regular intervals, such as monthly or quarterly, into an investment account or fund. This systematic approach to investing allows individuals to build wealth over time by taking advantage of compounding returns and minimizing the impact of market volatility. Here are a few examples of regular contributions. Systematic Investment Plan, SIP. SIP is a popular investment strategy in which individuals invest a fixed amount of money into mutual funds at regular intervals. For example, an investor might contribute $200 each month into a mutual fund. This approach helps inculcate discipline and reduces the risk of trying to time the market. Employer-sponsored retirement plans. Many employers offer retirement plans, such as 401k or 403b plans, which allow employees to make regular contributions directly from their paychecks. Employees can choose to allocate a certain percentage of their salary, such as 5% or 10%, to be deducted automatically and invested into their retirement account. Individual retirement accounts, IRAs. Individual investors can contribute a fixed amount of money to an IRA on a regular basis. For example, someone might choose to contribute $500 per month to their IRA. This helps individuals save for retirement while taking advantage of potential tax benefits. Education savings plans. Parents or guardians can set up education savings plans, such as a 529 plan, to save for a child's education expenses. Regular contributions can be made into the plan to build up funds over time to cover tuition fees, books, and other educational costs. Personal investment accounts. Individuals can choose to make regular contributions to a personal investment account. They can allocate a certain amount of money from their income, such as $300 per month, to invest in stocks, bonds, or other investment vehicles. The key idea behind regular contributions is to consistently invest a fixed amount, regardless of market conditions or short-term fluctuations. By doing so, individuals benefit from the principle of dollar-cost averaging. When prices are low, the fixed amount of money buys more units or shares, and when prices are high, it buys fewer units or shares. Over time, this approach can lead to a more favorable average cost per unit and potentially higher long-term returns. It's important to note that the specific amount and frequency of regular contributions will vary based on an individual's financial situation, goals, and risk tolerance. It's advisable to assess one's financial capacity and consult with a financial advisor to determine an appropriate contribution amount and investment strategy. Thanks for watching.